The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to the Texas Mortgage Bankers Association's Education Webinar Series, part of the Education and Endowment Committee led this year by Pam Jenkins and Dave Toggenbaugh. I'm Stephen Bertrand, and I'll be moderating today's webinar titled Strategies to Grow and Expand Your Construction Lending Program. We'd love to hear from you. Please feel free to ask questions throughout the webinar using the questions or chat window. If you have additional questions, please feel free to email Carol at the email address on the presentation slide. We're excited to have Zonda Mortgage as our sponsor for this webinar. Zonda is the leading data provider in residential housing, specializing in new construction. Their Mortgage Pro platform works to help lenders uncover new opportunities to work with builders, effectively track market share at the subdivision level, and recruit top originators in order to grow their new construction business. I'd like to introduce today's presenter. Shannon Ferries has lifelong experience in mortgage banking and construction lending. Shannon has founded and managed mortgage banking operations and is the former chief lending officer of a federal savings and loan. Throughout his career, starting as a loan officer, Shannon has focused on construction and renovation lending, A&D loans, and builder financing. In his role at Land Gorilla, Shannon oversees consulting and new product development for lenders looking to enter the construction lending space and provides best practices for loan program development and risk management. Shannon also manages strategic partnerships and provides consulting services for Land Gorilla's industry partners, including loan closing doc providers, MI companies, insurance providers, and government agencies. Also, I'd like to introduce Justin Alvarez at Land Gorilla. He assists Shannon with program development and, among other duties, he is essentially the company's Swiss Army knife and has assisted in risk analysis, lender training, and customer support. He will be displaying the presentation slides throughout the webinar. I've invited Justin to join in the discussion whenever he would like to. Okay, let's get started. Shannon, the presentation is all yours.
Well, thank you, Stephen. We have some interesting slides that we have prepared for today. The beginning slides, informational, and point out need for construction lending, sort of why behind construction lending. And after we get through the first series of slides, then we're going to get down into a little bit of the weeds of construction lending about how to structure your program, grow your program, some of the tricks and the tips. So on our first slide here, state of the housing market. We're going to talk a minute about that. We're going to talk about types of construction loan programs. Not everyone knows about them. We're going to talk a little bit about construction risk management. We're going to talk about standing up a new construction program. We're going to talk about sales and marketing tips that I've learned over the years, might be beneficial to you. And I end with talking a little bit about the weighted average yield of a consumer construction to perm loan. We refer to it as the WAY, the W-A-Y, the WAY calculator. Many lenders refer to it as the return on investment of a construction loan. Very important for lenders to understand that if you're going to engage, grow, and scale up a construction program. Next slide, please. Current state of the market. Let's go to the next slide. So this is an interesting slide, and it tells you year by year. It illustrates housing starts year by year, and you will see some very interesting ebb and flows in the housing starts. And you can see easily when the housing crisis, the global financial crisis set in, where housing starts plummeted. And that sort of takes us to where we are today. December 2023, there was only 1,000,004 housing start in the United States. That sounds like a big number, but compared to the past, it's not a number. Next slide. This is a great one. There aren't enough homes, and there aren't going to be enough homes. This is your reason as a lender why you want to engage into make construction loans. And I'm talking about consumer construction loans. There aren't enough homes. Next slide. Half of US housing inventory is at 40 years old. You stop and think about that for a moment. Half of the US housing inventory is more than 40 years old. Well, that means the life of the physical improvements of the home may be over. This is your open door to offer renovation lending, construction lending. 40 years old, that means the house probably needs its second or third roof, new windows, doors. The list goes on and on. A lot of homes cannot pass health and safety standards of the city or the county. Next slide. We aren't replacing enough existing homes. And this is interesting because 444,000 single-family homes are removed from the available housing inventory every year. This reduction in housing inventory every year because a home may not be able to pass health and safety standards. The home may have been red tagged by the city or the county. Homes are destroyed by fires, wildfires. We've had a whole bunch of wildfires in the state of California that's wiped out entire communities. Floods, hurricanes, tornadoes. 444,000 housing units are removed from that available inventory. And we just said in the previous slide that there was about 1,000,004 housing starts. So 444,000 has come out of that number. Next slide, please. And this is an interesting quote from the chief economist at Freddie Mac. We should have almost 4 million more housing units if we had kept up, with demand in the last few years. This is what you get when you underbuild for the last years. There aren't enough houses. Next slide. So this is kind of a controversial slide. This is something that we kind of debate about a lot internally here at Land Gorilla. And this is showing you the median price of a home in the United States is about $100,000, $405,000. And what it's telling you is that only 11.1 million households can qualify for a median home. Next. So that means only 8% of US households actually afford the median priced home. That is not good. That is bad. And public policy is to address this. You know, this percent number is the back of lenders that are members of the Texas Mortgage Bankers Association. This is your why. This is why you need to be involved in construction as well as renovation lending. The next slide. Types of construction loan. Next slide. We throw this in just because some lenders are not always aware of different types of construction loans that are actually available. It also includes a little breakdown of rehab loans, renovation lending. Some of you are familiar with some of those programs, but you might not be familiar with all of them. And so what we've tried to do, throw this out so that every lender that is listening to this webinar can visualize, gee, you know, we're a big USDA lender. Maybe we should be involved in USDA. Or maybe we should be involved in the Fannie Mae single construction to perm program. There's a fit here for every single lender. This call. Next slide. This is always a good talking point to bring up and to be thinking about and considering, and that is the ongoing debate between the benefits and advantages of a single close construction to perm versus a two-time close construction to perm. You know, a lot of the real estate agents, the brokers, loan agents refer to single close as one-time close. That's mortgage broker terminology. If you go into the fancy selling guide, they're referring to as the single close construction to perm. Freddie Mac refers to it as a construction conversion loan. Options to lenders. And we have many lenders on our technology platform that are very simple with two-time close. And we also have a lot of lenders are very successful with single close. And what drives that decision really is lender. What works well for the lender? It comes down to what is your loan execution. Are you a direct Fannie Mae or a Freddie Mac seller servicer? Well, if you're not, then you might opt in for a two-time close. So a couple of the benefits of the two, the pros and cons. Single close, the borrower qualifies one time. Uno, one time. The borrower only pays closing cost one time. Knows the permanent amortizing interest rate up front inside of the closing documents. There's the two close. It's a little different animal. Qualify for the takeout loan is required. Pre-qualification for the takeout loan is required. Qualify for the construction in order to qualify for this construction. Quality again, qualify again at the end of the construction bid. So that means a consumer is going to have to go through this qualification process multiple times. Some lenders are okay with that. Some borrowers are okay with that. Some are not. Next slide, please. So here are a few tips, construction loan risk management tips. Most of these are probably not new to any of you on the call. Most of you have heard this. Some of you know this. Some of you just need to have this confirmed in your thought process. Next slide. Numero uno, top one. The lender should only pay the contractor work that is completed. There are some exceptions. Contractor may need an advance of a deposit for building materials, things of that nature. That's reasonable. But that's outside of this number one rule. Only pay the contractor for work that is completed and has been inspected. Next slide. Implement builder policy. This is on the lender to do this. Not all borrowers know this is important. And notice that we don't say builder approval process. A builder approval would expose her to liability issues. So no lender should ever say that they're approving a builder. You're simply accepting or not accepting the borrower's choice for the general contractor. And it's okay for the lender not to accept the borrower's choice. Lender, we follow the golden rule here, and the lender has the gold. The lender makes the rule. I'm either going to accept or I'm not going to accept the borrower's choice. And so here's some of the criteria that goes into this. Builder acceptance could include, probably should include all of these things. Builder license verification, a background check, and I don't check it on the internet. I mean, like something like a LexisNexis background check that is checking for public records, tax liens, judgments, lawsuits, things of that nature. Some lenders do a financial check, actually look at the builder's tax returns, simply because they want to know the builder can cash flow and does not need working capital. Some lenders forego the financial check. A resume is helpful just to understand who the builder is, where they build, how many homes have they built, et cetera, et cetera. Trade references are very valuable information to have. Most of the trade references are going to turn up in the background check. Builder acceptance helps to avoid failure to complete. This is the number one reason lenders have concerns about originating a construction loan. What's the worst that can happen? Failure to complete. Where does failure to complete come from? It comes from the builder most of the time. 90% of the time, it's all about the builder. It's not about the borrower. It's not the supply chain. It's about the builder. Failure to complete. Remember that. Builders have been known to take advanced funds and not pay subcontracts. We don't want to see that. We don't want to see builders running off with them. Next slide, please. This is an important point to make because lenders that plan on scaling up a program that becomes an ongoing revenue source, you need to utilize a system of record. We here at Langrola refer to this as the SOAR, the S-O-R, the system of record. Essentially, that a Langrola technology platform is. It's a system of record. And the system of record is used by the lender to protect themselves over lender liability issues that can result. Makes everything very easily accessible. All the information, the draw requests, the builder budgets, the inspections, et cetera, et cetera. A true system of record is admissible into court. If you ever have the opportunity to be drug into court over a lender liability complaint. And so it's very important. And I would add that a spreadsheet An Excel spreadsheet is not a system of record, but an Excel spreadsheet can be used very easily if you're going to close a couple of construction loans a month, but you're not intending on scaling it. And thanks, Justin, for pulling that up. And there's a little bit better explanation and between the difference between spreadsheets and actual software that isn't a system of record. And I know in my career, I always used a spreadsheet. But that has been many, many ago, and lender liability issues were not as prevalent as they are. Next slide, please. Best practices for consumer construction to perm process. And we try to break it down into the pre-close process and the post-close process. And what we're trying to illustrate here is some of the important points having to do with the pre-close process. And it could always include who's the builder, what's the builder's qualifications, license, general liability insurance, references, background check, that type of thing. Because it's incumbent upon the lender to accept the borrower's choice of a contractor or to decline the choice. And it's okay to do one. You don't have to automatically accept a borrower's choice just because you want to close a loan. No, that would be a bad practice. The second point that we'd like to make here is that every loan should have a project review, a construction project review. What's involved in a project review? Well, the lender should collect and analyze the builder's budget. Some people call it the cost breakdown. And so the cost breakdown is vitally important because you need to make sure that the builder actually has all of the costs of construction inside the construction contract as enumerated by the builder's budget. The lender needs to review the construction contract. There's many different types of construction contracts. For most entry-level housing, FHA, Fannie, Freddie, USDA, the recommended choice would always be a fixed price contract, not a cost plus contract. There is a place in the world of lending for a cost plus contract, but it would not be for entry high LTV lending. Very important to check the status of the building permit. I cannot tell you how many clients we have seen that have gone ahead and closed construction loans without consideration for the building permit, only find out that the contractor hasn't even applied for the permit. Well, that can throw off the construction term. If you're planning on a 12-month construction term, the builder has just eaten up 3 months because they hadn't applied for the building permit. So that's not a good thing. That means you would have to extend the construction period. And you might miss the opportunity to deliver the loan into the secondary mortgage market. So the best practice is you don't close the loan until the building permit either been issued or it's ready to be issued and the lender has physically called the planning department or the city or the county to check what is the status of the permit. Oh, it's ready to be poured, it's ready to be picked up. Well, that's a good thing. You know, that's a very simple process then of the contractor walking in and handing check over to pay for the building permit. But if the building permit has not even been applied for, that's not a loan that's ready to close. No, no, no. That loan that's verified and approved but not ready to close. So building permit is always a very big issue. then there are some states, there are some counties that do not issue building permits. And so you don't want to miss that. It's something to keep your eye on. It's something to be aware of. Review of Schedule B of the title policy. We oftentimes remind lenders that when you're underwriting construction loan, it's very important for you to review the title policy, Schedule B. And because that will list all the exceptions to the title insurance policy. And it may list requirements that call out for homeowners association approval of the building plans or building setbacks or zoning issues. So most lenders have underwriters that are very experienced at reading title policies. Title commitments is what I'm talking about. And there's a few hot buttons inside of Schedule B of a title policy that could be of concern to any lender that's contemplating the closing of a construction loan. That's all done before the loan is closed. And then number 3, which actually is part of the project review, but we kind of call this out separately, and that is to alert everyone that the maximum loan amount really is based on the acquisition cost. And so you need to be aware of the acquisition cost is. Cannot go to the Fannie Mae selling guide, it's not there. They do not define the cost of construction. Fannie Mae takes the position the lender's supposed to know what the definition of the cost of construction is. Fannie Mae and Freddie Mac reference the cost of construction is financeable. They say it over and over in their selling guides, but they don't come out and tell you what the cost of construction includes and what does not include. And so having a very thorough understanding of the industry best practice for understanding acquisition cost is very, very important. And acquisition cost includes the cost of the land, the hard cost of construction as referenced in the builder's budget. It includes the loan closing costs, and it includes reserves for contingency. All of the cost of construction. We have a real good acquisition cost worksheet. If anyone on the call wants a copy of the acquisition worksheet, we'd be happy to provide it to you free of charge. Next slide. Best practices for consumer construction department post-close. So this is the draw management piece. And there are many lenders that manage the draws on their own because they have experienced people that understand lien waiver control, builder budgets and sections, that type of thing. But a lot of lenders that are standing up a construction program do not want to incur the fixed expenses and the fixed overhead of a large department of people managing draws. So those lenders generally will outsource that process. They may outsource it to Land Gorilla. They may outsource it to another vendor. Either way, draw management and lien waiver control are very, very important in this process. And I would say in our world at Land Gorilla, we encourage the use of conditional lien waivers so that the builder signs lien waiver at the same time that they request the draw, but that's done before they get the draw disbursement. So there's a few other interesting points here. You're going to all get a copy of this, of these slides anyway, so I'm not going to go through all of these. Next slide. Standing up a new program. Maybe this is what some of you would like to hear the most about. And so next slide, please. 3 phases of standing up a construction to perm program. Phase 1, select a program. Which one are you going to offer? I just went through a whole list. Probably the most popular right now on our technology platform is the Fannie Mae single close construction to perm. That's probably 80% of what we see in the industry. So selecting a program is very important. But you might be heavily into government lending. Well, there's FHA, there's VA, there's USDA. That's part of that process. Select a program manager. There's someone inside your organization that has to bear responsibility for everything that goes on. And so there needs to be a key management individual. Sometimes it's someone in the operations department. It could be someone in underwriting. It could be someone, in the C-suite. That's all lender driven. Portfolio versus secondary loan sales. Some of you could be portfolio lenders, banks, credit unions, private equity groups, and some of you are independent mortgage bankers, and you intend on selling the loan at completion to Fannie Mae or Mac. If it's a USDA loan, you would sell the loan in a Ginnie Mae mortgage-backed security the same month that the loan is closed. Identify your borrower's needs. Loans are a big part of construction lending. Construction perm, manufactured housing is a very big component here across the country, and that's driven by costs, consumer costs, the cost to get into housing. We talk a lot about MH Advantage. That's the new program from Fannie Mae that's getting a lot of attention by consumers. So that's something to think about. Phase 2, develop written policies and procedures. And if you don't have them, they're out there. This is what Justin and I work on every day. Written policies and procedures for lenders. Because you can't really manage your risk if you don't have written policies and procedures that have been endorsed by the senior management of your company. Plan phone administration. Is it going to be in-house? Is it going to be outsourced? You can do it either way. If you're going to do it in-house, you better have trained people that are very experienced with lien waiver control and loan disbursements. Training for loan officers and loan processors. That's part of phase 2. And as we all know, there's a whole new generation of loan officers that probably were licensed after the financial crisis when refinances were the game of the day. Well, that's all over with. So loan officers oftentimes need training and introduction into the basic principles of how to originate a construction to perm loan, because there are more moving parts. And a trained loan officer that understands these can sell themselves and market themselves as a construction loan specialist. And I think that's very important. Next slide. The 3 phases of standing up a construction to perm program. Phase 3. How about the TRID disclosures? Hey, that's a good one. You get a lot of questions about TRID disclosures and how to correctly disclose. And the fact of the matter is that most LOS systems do not have good support for construction perm lending. So if you are using an LOS system, most of the mortgage bankers are using an LOS system, you're going to have to dive down deep into the correct way to issue the LE and the CD, the closing disclosure, to be compliant with TRID disclosures. because the CFPB has said in its infinite wisdom that it will give a disclosure on a consumer construction to perm loan. Plan for pre-close process. Plan ahead for the pre-close process. Make sure that the contractor is aware they're going to have to submit an application for acceptance. The builder budget is going to have to be on the lender's form, not on the builder's form. That doesn't work. Not a good idea. It's important, here's a good one, define your draw process and the workflow for the draw. We never encourage staged draw schedules. You might use it under manufactured housing, but you probably should not use it under site-built housing, certainly not for entry-level construction to perm loans. And the draw schedule should be based on a percent of completion, meaning whatever the contractor has complete as of the date of the inspection, the progress inspection, that's what the contractor is eligible to draw from the builder's budget. That is defining your draw process. A percent of completion is probably the best practice. Many lenders, if they use a stage draw schedule, you could very easily over disperse the funds to the builder relative to the stage of construction. In fact, that's what a stage draw schedule is for. The intention is to disperse more funds to the builder up front than what is actually been completed on the job site. So let's go to the next slide. Sales and marketing tips. Oh, this is a good one. I always enjoy this. Next slide. The art of selling a one-time close construction to perm. And this would be, with the loan officer, how to sell. How loan officers can sell construction loans to the borrower, to the consumer. And I would emphasize here, anyone listening, that loan officers by nature tend to want to sell the lowest interest rate that they can, the lowest cost that they can. But in the case of construction to perm lending, it's really not about the interest rate. It's not about the interest rate during the construction period, and it's not about the interest rate that's recited in the addendum to the note for the amortizing portion. Construction to perm loans, it's all driven by features. And so we're going to some of the features right here. It's not all of them, but it's feature linked. A good loan officer would not focus on cost, focus on the features of the loan that benefit the consumer. How about the fact you only have to qualify for the loan one time? How about you only have to pay the closing cost one time? Those are very important features. And to follow acquisition cost, you would always include a contingency reserve, an interest reserve, and you would never limit change orders. So interest reserve and contingency reserve are both funded from the borrower's loan proceeds. And so it's very different for a consumer when they realize, the construction interest rate might be 8.5, but I'm not going to write a check for it every month. It's coming out of the loan amount. That's much easier to sell to a consumer than otherwise. So what the competition is doing, a lot of your competitors don't allow interest reserve. A lot of your competitors restrict the contingency reserve. the reserves should always be set up as 10% of hard cost of construction in case change orders that change the cost, or in case there are shortages. It's not common for borrowers to get involved in a change order to upgrade kitchen countertops, appliances. It's done time, so you don't ever want to limit that. Give them a free hand at it. Next slide. Grow and refocus. I think it's important for listeners to understand that most construction loans are referred to the lender by the builder or someone in the construction trades. And so that's very, very important to remember, especially for loan officers, because if you're going to grow your market, you cannot do it behind a desk. That is death. That's not going to work. So a loan officer is going to actually have to get out and physically call on home builders, real estate agents, real estate brokers, financial planners, the CPAs, subcontractors, because those are all sources of referral. Very difficult to referrals over the internet. And I'm going to give you a couple exceptions to that. But let's see, let's move on a little bit here. Community outreach is really, really important. And this kind of gets back to some of the old school marketing that loan officers have engaged in the past. You physically have to get out and meet these contractors. You have to go to their sales office. You have to go to their subdivision if they're a tract home builder. You have to present yourself, and you have to present your company. And so there's ways to do this, but it's not going to be from behind a desk. So don't expect that. Don't expect your employer to generate all the referrals for you if you're the loan officer. Now, there's always the lunch and learn with realtors and builders. That's very old school. It's very traditional, but they appreciate it. They will remember your name. Contact the local housing authorities. Every city, every county has got housing authorities. Go in and meet and greet them. Tell them what you're doing. Tell them you offer construction loans. Ask for opportunities, to present your program. Here's a good one. Visit the local builder exchanges. Many lenders don't even know they exist. But a builder exchange exists in almost every small town, every community. Sometimes there's multiple builder exchanges. This is where the builders hang out. This is where the subcontractors hang out. This is where builders and subcontractors can view building plans. Consumers are getting ready to start homes on. Well, that's a great opportunity to meet and greet builders. Most of the builders exchanges have monthly meetings and luncheons and stuff like that. The other thing that I would note that sometimes lenders forget about, and that is public record. Public records are free. They're available. So anytime a consumer or a builder applies for a building permit or a grading permit, that's a public record. I can walk into the county planning department in my own town, and the planner behind the desk will give me a printed list of, well, here's the list of people that applied for a grading permit. Here's a list of people that applied for a building permit. And guess what? It's got all their contact information. And in my county, that list is free. You just have to ask for it. Sometimes you have to wait to get it because they're busy, but that is public information that you can certainly build referrals from and take advantage of that. So internal education is another opportunity. Information sheets for loan officers, bank tellers, oftentimes will pass them out for you, loan processors. So next slide, let's move to the next slide. Introducing the weighted average yield calculator. This is something that Justin and I have spent a lot of time on. Let's go to the next slide. Anyone on the call today, is able to get the weighted average yield calculator by just using a QR code. I think Justin will bring it up on the screen. But the purpose of a weighted average yield calculator is to allow a lender, usually this would be the secondary marketing department, the CEO, the CFO, capital markets groups, to visualize the return on investment of a construction loan. Because most mortgage bankers do not know this. They don't appreciate it. They haven't seen it because it's not normal to them when they're selling loans in the secondary mortgage market that are purchases or refis. And so there's three phases of the construction loan. Obviously, the construction period limited to 3% of the loan amount under TRID. There's the interest only portion, and that's interest only on the funds dispersed during the construction period, based on the progress of construction, not based on a staged draw schedule, but based on the percent of completion. And then last of all, and not least, is the gain on sale. Some people refer to it as the GOS. I refer to it as the gain on sale. When the permanent loan is sold into the secondary mortgage market, you need to have clear targets as to what your engine is for the gain on sale, because those three items on this list make up the weighted average yield, which tells you the return on investment. Next slide. There we go. Here's this is a clip of a portion of the upper portion of the weighted yield calculator. And it clearly breaks out the interest rate during the construction period. And on this screen, you can see it's 7.375. And in this screen, the permanent rate is shown as 9. And it actually breaks out the principal and interest in it as well. Most single close construction loans have a split interest rate. Would be one interest rate during the construction period, 7 3/8. That's interest only on the funds that are dispersed as the builder requests the draw. A single close loan should also call out for what the permanent amortizing interest rate should be, so the borrower knows it up front. There's no guessing. The borrower needs to know this when they close the loan. And in this case, we're showing a slightly higher rate than the current market interest rate, which is probably in the mid 7s, I would guess today. But we show the permanent rate as 9. And it's understood and recommended that the mortgage documents refer to a float down option of the permanent interest rate. And the float down option can be found in the addendum to the promissory note, commonly referred to as Form 3736 in the Fannie Mae Selling Guide. So this breaks out, this is a programmable calculator where the lender can input things, the variables that may be specific to the lender. If you're an independent mortgage banker, you're probably going to utilize a warehouse bank to fund these loans. And it's very important that an independent mortgage banker negotiate the cost of funds on the warehouse line. That cost of funds on a warehouse line should actually be a lower cost of funds than the warehouse bank might be offering for purchase money loans or refinances. And that is because a construction loan is going to dwell on a bank's warehouse line for 10, 12 months. Therefore, they've got more of a cushion to negotiate with the lender over the cost of funds. Most warehouse banks use the SOFR index as their cost of funds, what they're going to quote to you. But that doesn't mean that you can't negotiate it. And so we oftentimes see lenders, banks, they negotiate a warehouse line of credit. They add a premium to the index over the SOFR index. And so if the bank is going to quote you SOFR, that means independent mortgage banker, that's not the rate that you're going to offer borrower during the construction period. No, you'd go upside down doing that. To create a margin above your cost of funds. The standard in the industry for an acceptable margin above the cost of funds on the house line would be at least 2, because the index rise during the construction period. Doesn't look like that's going to happen this year. And so we want to make sure that inside the weighted average yield, you're getting money during the construction period, which could be 12 months. And so you need to be generating revenue on a spread over your cost of funds index, because that's part of the weighted average yield. In an example, we show a projected gain on sale, let's say to Fannie Mae, that's the target, 2.5%. But I have clients that use much larger anticipated on sale targets, but that's all up to the lender. That's all up to the capital markets group. You know, what is our target for the gain on sale? And so let's go to the next slide, Justin. Okay, so here is the weighted average yield calculator. It's pretty small on the screen, but this shows you the upper portion that we were just talking about, where you would input the loan amount, the loan to value ratio, the funds, the interest during construction, permanent interest rate, et cetera. And if you go down, way down at the very bottom, you'll see in this particular example, construction to perm loan, Justin is pointing to it. This is anticipating a weighted average yield or return on investment of 4%. I'll bet 2 or 3 times most of these banks on this call are currently, when they sell a loan to Fannie Mae or to Freddie Mac. 4.6, that's enough to get my attention as a mortgage banker. That's spread out over a 12-month period. You've got to realize that. And so there is a QR code here. You can click with your phone if you'd like to get a copy of the weighted average yield calculator. We're happy to provide it to you. No cost, no obligation. You don't have to like it. You can love it. We don't care. It's up to you. If you have an interest in getting a copy of the addition cost worksheet, we're happy to make it available to you as well. Slide.
And then we do also, if I may, Shannon, we just also wanted to relay to you that one of the biggest efforts that we're making right now is to provide a lot of learning content and discussion around construction lending. And so we also invite you to subscribe to the Construction Lending Podcast, where we cover the challenges that lenders such as yourself face with construction and renovation loans. And you can find that at langorilla.com/podcast.
Yeah, that's really important because a lot of the lenders on this call today they lend in multiple states. They're not just in the state of Texas, New York, California. And so these state-specific rules, laws can all be found on our website. You can research them yourself, but it makes it much more convenient if it's all located in one area. And you can certainly get in trouble and hung up on state-specific issues. So that's a very important thing to mention. Thank you, Justin.
And with that, I guess we'll pass it back to our gracious host, Stephen, and TMBA.
Thank you. We do have a question, Shannon, and a little bit of time to cover it. So here it is. What happens if construction stops and the house is not completed on time? And what steps can be taken to reduce that risk?
Well, I guess, that kind of goes back to just the best practice of vetting out the contractor. Number one reason that this occurs, it's all about the contractor. And so this could be a situation where the lender did not vet out the contractor, maybe. And so failure to complete is probably the number one concern the lender. What happens if they don't finish the house? The bottom line is the borrower has signed a promissory note and they have signed a construction loan agreement. That's legally binding between the lender and the borrower. The construction loan agreement should call out for the number one event of default under the loan agreement as non-completion. And so if that were to occur, a lender would need to accelerate the promissory note, issue a notice of default, and move it into foreclosure. I mean, that's the worst case that could probably happen. There are occasions we get involved in a dispute between the contractor and a borrower, and usually it's something pretty easy to, to deal with. But there's the need to really be very diligent about who the contractor is in the first place. And a lender does not have to accept any contractor. So that's why this vetting process is very, very important, because that helps to prevent not only disputes, contract disputes, but the very issue, that your attendee is bringing up on call. And so we don't see it very often. The reason we don't see it very often is because we vet the heck out of the contractor. If we're managing the process, we know who this contractor is. We know what their track record is. We know that there aren't tax misjudgments, lawsuits, and that type of thing, in the builder's background. And so I think that kind of underscores that very issue. We didn't see a single default on a construction during the COVID virus debacle. For supply chain issues, we didn't see any problems related to supply chain. We saw some delays on getting garage doors and appliances, but we didn't see defaults. So thank you for the question, Stephen.
Sure. Yeah. Thank you for answering that. And there's one more here. How should we determine interest rates for construction and for the permanent loan? And related question, how can we address the possibility of higher rates when the loan converts?
Yeah, no, that's a good question. And I think we have that in the weighted average yield calculator. But a lot of people ask this question about on a single close loan, you know, I'm coming to a permanent amortizing rate, but yet I haven't sold the loan to Fannie yet. That is why you would have to quote a market interest rate well above current market rate today. Current market rate today is 7.5 or 7 7/8. Well, you would never quote that as the interest rate for amortization under a single closed loan. You're going to quote something well above that. But this question can best be answered if a lender would take a look at Form 3736 found in the Fannie Mae Selling Guide. And that breaks out the interest rate during construction, the interest rate for amortization. It calls out for a completion date and calls out for a conversion date when the loan will convert to amortization. But even more important is the fact that that Form 3736, which is the conversion document that most of these loans utilize, should have a feature that allows for a float down, because what happens if interest rates take a big dip later? Meanwhile, you've committed to 1% amortizing rate to the, and interest rates drop to 6. Well, no borrower is going to accept that. But they would accept the float down to the current market interest rate. And that, as I said, would be found in this Fannie Mae Form 3736, which is commonly used for a single close construction permit. In our case, we modified Form 36 to include the verbiage of a float down option, which is allowed.
Thank you. And Shannon, thank you for taking the time to share your knowledge and experience with us. Thank you all for attending, and we hope you have learned more and enjoyed our presentation. TMBA continues to bring you great webinars like this one. Please check out the homepage at texasmba.org for the upcoming schedule. Thanks again, everyone, and that concludes our webinar.
Thank you for the opportunity.
Our pleasure.